You work harder than your parents did. You're more educated, more productive, more connected, and yet somehow you feel further behind. Housing costs more, education costs more, healthcare costs more. Retirement feels further away than it did for the generation before you. You're not imagining it. The numbers confirm it. But here's the question nobody in power wants you to ask. Is this happening to you, or is it being done to you? Because governments don't just collect taxes. They have an entire toolkit of financial mechanisms, most of them invisible, almost none of them discussed in schools, that quietly shift wealth upward, from workers to owners, from savers to borrowers, from the many to the few. These tricks aren't new. They've been refined over centuries, and the reason they still work is simple. Most people don't know they exist. This is EcoHistory, where money, power, and history collide, and the past always has something to say about the present. Let's talk about the game and how it's rigged. The first trick is the oldest, and it's hiding in plain sight. Every major central bank in the world, the Federal Reserve, the European Central Bank, the Bank of England, has an official inflation target of 2% per year. Not zero, not as low as possible, exactly 2%. That means the most powerful financial institutions on Earth have collectively decided that your money should lose purchasing power every single year, by design, on purpose, as policy. At 2%, your money loses half its value in 35 years. The savings your parents set aside in 1990 by roughly half of what they bought then. And 2% is the best case. Between 2021 and 2023, U.S. inflation peaked at over 9%. UK inflation hit 11%. Prices rose faster than at any point in 4 decades. Meanwhile, the average savings account paid 0.5% interest. That gap between what savings earn and what inflation takes is not an accident. It's a transfer from people who save to governments that spend, from workers who earn to institutions that borrow. Roman emperors did the same thing with silver coins. They kept the coin, they removed the silver. The face value stayed the same. The real value shrank. Today, we don't shave coins, we print currency. Different method, same outcome, same victims. You get a raise, 5%, you feel better. But inflation ran at 6% that year. In real terms, you took a pay cut. Now add another layer. That 5% raise pushed you into a higher tax bracket, so the government takes more of every dollar you earn above the threshold. Your gross income went up, your purchasing power went down, and the government collected more from you without ever changing a tax rate. This is called bracket creep, and it is one of the most effective silent tax mechanisms in the modern state's toolkit. In theory, tax brackets are supposed to be adjusted for inflation every year. In practice, governments adjust them slowly, partially, or not at all, especially when fiscal pressure is high. The result is that inflation does the work of a tax hike without any politician having to vote for one. Nobody announces bracket creep. Nobody campaigns on it. It just happens, quietly, every year to people who are already running to stand still. Here's one most people have never heard of. When a government creates money, through the central bank, through bond issuance, through quantitative easing, it earns a profit on that creation. The technical term is seigniorage. It comes from the French word for lord, because historically, the lord of a territory had the exclusive right to mint coins, and every coin minted was worth more than the metal inside it. The difference was profit for the lord. Today, it works differently, but the principle is identical. The Federal Reserve creates money to buy government bonds. The government gets the money. The Fed earns interest. That interest flows back to the Treasury, billions of dollars every year, extracted simply through the act of money creation.
In 2022 alone, the Fed remitted over $76 billion in profits to the U.S. Treasury, not from taxes, not from productive activity, from the act of creating currency. This is a power no private citizen or corporation has. Only the state can manufacture money and profit from the manufacture, and every dollar created this way dilutes the value of every dollar already in existence. You hold the dollars, the government holds the printing press. The game was never equal. When central banks create money and keep interest rates low, that money has to go somewhere. It goes into assets, houses, stocks, land, art, anything that stores value. Asset prices rise, and here is where the trick reveals itself. If you own assets, if you bought a house before 2010, if you hold a stock portfolio, if you inherited property, low interest rates and money creation make you richer automatically, without working harder, without producing anything new. If you don't own assets, if you're young, if you rent, if your wealth is in a savings account, the same policies make your situation worse. Rents rise because house prices rise. The deposit you need grows faster than you can save it. The stock market recovers while your paycheck doesn't. Since 1971, U.S. house prices have risen roughly 2,000%. Wages have risen roughly 600%. That gap is not a market failure. It is a policy outcome. Central banks know that low interest rates inflate assets. Governments know that asset owners vote more reliably than renters. The incentives align, just not in your direction.
The wealth divide doesn't need to be actively maintained. The system maintains it automatically. Every time interest rates are cut, every time money is printed, every time another generation discovers that the ladder was pulled up before they arrived. Debt is the most elegant control mechanism ever devised. A person in debt works harder, takes fewer risks, accepts worse conditions, doesn't strike, doesn't quit, doesn't make trouble. This isn't conspiracy, it's arithmetic. If you owe 30 years of mortgage payments, you cannot afford to lose your job. If you carry student debt from your 20s into your 40s, your choice is narrow, your leverage shrinks, your dependence grows. Governments and financial institutions figured this out centuries ago. In medieval Europe, debt bondage kept peasants tied to land they didn't own. Today, the mechanism is more sophisticated, but the outcome rhymes. Consumer credit, student loans, and mortgages are the new chains, invisible, voluntary, and almost impossible to escape once you're deep enough. Total U.S. consumer debt now exceeds $17 trillion. The average American household carries over $100,000 in debt. Student loan debt alone exceeds $1.7 trillion, owed mostly to people who were told that borrowing was the only path to opportunity. Indebted people are predictable people. Predictable people are profitable people. That's not an accident, that's a business model. And governments benefit from the stability it creates. When banks and corporations take risks and win, the profits are private. When they take risks and lose, the losses are public. This is not capitalism, it is something else. A system where the upside belongs to shareholders and the downside belongs to taxpayers. In 2008, the U.S. government committed over $700 billion to bail out the financial institutions that had engineered the housing crisis. Banks that had sold fraudulent products, paid executives hundreds of millions in bonuses, and knowingly pushed the system to the edge were rescued with public money. 1 year later, bonuses were paid again, profits recovered, share prices climbed, and 8.7 million Americans lost their jobs, 4 million families lost their homes. Not one senior executive went to prison. This wasn't a one-time failure, it was a demonstration of the rule. In 2020, when COVID hit, the Federal Reserve backstopped corporate bond markets, buying the debt of companies that had spent years buying back their own shares instead of building cash reserves.
The companies survived, their shareholders benefited, the workers were furloughed. The game is rigged not because governments are evil. It's rigged because the people who design the rules are the same people who benefit from them, and they have been for centuries. The last trick is the most philosophical and perhaps the most dangerous. Governments can spend money today by borrowing it from the future. They issue bonds, they run deficits, they promise to pay later. The spending is visible now. The cost is invisible because it will be paid by people who haven't been born yet or who are too young to vote. This is called fiscal illusion. The public receives services today and feels no immediate pain. The bill is deferred. The politician who spent the money is long gone by the time it comes due. The U.S. national debt now exceeds $36 trillion. It grows by roughly $1 trillion every 100 days. Every American alive today, including newborns, carries an implicit debt burden of over $100,000. Nobody voted for this. Nobody was asked. The obligation was created by decisions made decades ago, compounded by interest, and handed forward in time to people who had no say in the matter. This is the ultimate trick. Not taking from your pocket, taking from your children's pocket before they're old enough to notice. None of these tricks are secret. They're in economics textbooks. They're in central bank policy statements. They're in government budget documents that anyone can read. The problem isn't access to information. It's that the system depends on most people never connecting the dots. Because the moment you understand that inflation is a tax, bracket creep is a hidden rate hike, asset inflation is a wealth transfer, and debt is a control mechanism, the game changes. Not immediately, not completely, but your relationship to money changes, your decisions change, your expectations change. Every one of these tricks has a history. Roman emperors used seigniorage. Medieval lords used debt bondage. Weimar governments used inflation. Every era had its version of the same tools. What changes is the sophistication. What doesn't change is the direction of the transfer. Understanding the game is the first step to playing it differently. History already wrote the ending. We're just living through the chapter. If this gave you a new perspective, subscribe. The past has answers. We'll find them together.